So good morning, everyone. And once you check what we have discussed yesterday, so relating to the accounting for business combination. So under acquisition method, we have to follow some steps as I told you. The first one, identification of acquirer. Which acquirer? Accounting acquirer. Second one, Anna, determination of date of acquisition. If any government approval is required, date of approval by the government will be considered as date of acquisition. Third one, purchase consideration. So generally it will be available. If not, we can prepare the purchase consideration. The computation measure is like that. All the fair values of taken assets given, equity shares given, or preference shares given, or debentures given. So all the things. So including to that, present value of deferred consideration also taken into consideration. At the same time, fair value of contingent consideration. And coming to fourth one, identifying net assets taken over by the company, acquiring company, by the acquirer company. So what are the net assets of acquiring company? First you have to identify. So that net assets taken over by the acquirer company, net identifiable assets. What is net identifiable assets? What are the assets we are taking and what are the liabilities we are taking? What is the net value for that? Okay. If net assets directly given in the question, directly we will take, or otherwise assets separately and liabilities separately if they have given, the difference we have to take. Assets minus outside liabilities will be the net identifiable assets. Net identifiable assets. Simply identifiable assets minus identifiable liabilities will be the net identifiable assets. Net identifiable assets. So net assets we have to take. At the same time, so generally all the assets and liabilities taken over, from the acquiring company, that will be recognized at fair value on the date of acquisition. So the recognition principle is what, Nana, here? We have to record that fair value on the date of acquisition. While coming to, if any non-current assets held for sale is there, that will be recognized at fair value less cost of disposal according to Ind AS 105. So here it is an exceptional rule for recognition. So it is an exceptional rule for recognition because as per business combination, as per Ind AS 103, we will recognize the assets and liabilities at fair value, not fair value at cost of disposal, right? So we will recognize that fair value. But some exceptional cases we are having, that is like if any non-current assets held for sale is there, directly you should not recognize that fair value. We have to recognize that fair value less cost of disposal according to Ind AS 105. So according to Ind AS 103 means we have to record that fair value. But 105 is saying what, Nana? Fair value less cost of disposal. In this regard, we will follow Ind AS 105 for the recognition. So it is an exception for recognition under 103. It is an exception or not? So as per Ind AS 103, Ind AS 103 is saying that all the assets and liabilities what you are taken over should be recognized at fair value on the date of acquisition. But non-current assets held for sale, we are recognizing at fair value less cost of disposal. Net fair value we have taken over there. So in such condition, that is as per Ind AS 105. For that respective principle, we are following Ind AS 105. Okay. So there is not a brief in case of exceptional rules and here and there, but we will see that one also. Next one, intangible assets. Intangible assets that meets the recognition criteria of Ind AS 38 but not recognized by the acquiree shall also be taken over by the acquirer at fair value on the date of acquisition. So examples, internally generated goodwill or patents or customer list if anything is there. So such kind of intangible assets, so that can be recognized by the acquirer at fair value. Okay, so generally internally generated elements should not be recorded in the balance sheet. Simply we can say if you have purchased goodwill, you can recognize it in the balance sheet, but self-generated goodwill is not required to be shown in the balance sheet. But as per acquisition principle, that self-generated goodwill also to be recognized at fair value on that particular date of acquisition. Okay, so next one, if contingent liabilities are there, that contingent liabilities also we will recognize that fair value on the date of acquisition. Then contingent liabilities, how you will recognize? For acquiring company, it is contingent liability. When you are recognized in your books of accounts, it is a liability. So like a liability, we will recognize. Again, we should not recognize as a contingent liability. Their contingent liability, we will recognize it as a liability. So at fair value on the date of acquisition. Next one. See if any indemnification asset is there. See if any indemnification asset is there. So that also to be recognized. That also to be recognized. That is not there in the balance sheet of acquiring company. It is not there in the balance sheet of acquiring company. But as per acquisition, that measurement we are taking for identification of asset for acquisition purposes. For acquisition purpose only, we are identifying the what? Indemnification asset. What is indemnification asset, Nana? The amount compensated by the acquiree, the amount compensating by the acquiree by the amount payable on terms of contingent liability. If any contingent liability is there, for that contingent liability, if any compensation is paid by acquiree, such compensation we can call it as indemnification asset. So indemnification asset which is not there in the balance sheet of acquiree, right? Acquiree balance sheet is not there, but we are recognizing that asset also, indemnification asset also, because it is promised by the acquiree. It is promised by the acquiree. If any contingent liability is payable on that time, he will compensate that amount. Okay. So maximum how much he can make, Nana? Indemnification asset shall not exceed the contingent liability. Up to contingent liability, how much is there? That much indemnification you can make. And last one, reacquired rights. Okay, if any reacquired rights, initially we have given right to license or right for franchisee or something for the acquiring company. Now for the acquisition purposes, we are reacquiring such rights, that also to be recognized at fair value on the date of acquisition. So how can we make, for example, in acquiring books of accounts, in the balance sheet, so one license is there. For example, for 10 years license we have given for 10 lakhs, as I told you like yesterday example, 10 years license or 10 years patent right you have given for 10 years. So 10 years, if it is 10 lakhs, 3 years already completed, Nana. Can we make amortized 3 lakhs? So net carrying amount how much? 7 lakhs. This is carrying amount. This is carrying amount of that particular patent or license in the acquiring books of accounts. So 7 lakhs is the carrying amount. The fair value of this amount we have to check. What is the fair value? Now how many years left? 7 years. For 7 years, what is the market price? For the 7 years, if you want to take the license in the market, how much is the price? So the fair value we will recognize. This is the carrying amount. In the market, for the 7 years, if you take, you are getting for 5 lakhs means 5 lakhs we will take. If you have to get the 10 lakhs means 10 lakhs we will take. So the fair value of the reacquired right should be recognized for acquisition purposes. So these all are the 10 points yesterday we have discussed. So once you go through it, Nana, just 5 minutes review. So then we will start with our accounting aspects. Now, relating to reacquired rights, again we will discuss that in Ind AS 38, intangible assets. When we are doing intangible assets, we have problems on that. Okay, just for example sake, I told you, if any license or franchise rights you have given, for how many years you will give, for how much amount, we know that. That is the cost price of that particular license. In order to give that such patent for usage of that such patent, so for 10 lakhs, as I told you, for 10 years. 10 years means it will be amortized year after year. Intangible assets are amortized or not? Yes. So it is amortized. If 3 years completed means up to 3 years, how much is amortized amount we can remove, and the net value we are recognizing, that will be the carrying amount. The carrying amount what is showing in the what is the carrying amount which is showing by the acquiry books of accounts, it may not be the fair value. On the market, some other price it will be there. Okay, for the same 7 years left, 10 years right, 3 years completed, 7 years left. The same 7 years right, if I want to purchase from the market, what is the price on that particular date? That will be the fair value. So carrying amount is there, fair value is there. We have to recognize that fair value, not the carrying amount. That is what here the reacquired rights will be taken out. Same like assets, carrying amount is there, assets fair value is there. Assets we are taking at fair value. In the same way, reacquired rights also we have to take over at fair value. Okay, Nana. So next, in this aspect, we should know some elements. For example, A Limited, and listen carefully. A Limited acquired B Limited. A Limited acquired B Limited. So B Limited is acquiring company. So here acquirer, acquiring. Nana, acquisition means, for example, as I told you, so we are purchasing more than 50% of the stakes, then you will get the control over the aspect. So here 100% acquisition, 100% acquisition. So that means A Limited purchased entire net assets of B Limited. A Limited purchased entire net assets of B Limited. First we have to check acquiring company B Limited, what is the amount of net assets? We have identifiable assets, fair values only I'm talking about, fair value of identifiable assets. Fair value of identifiable assets, we're having 1000 lakhs, 1000 lakhs. Fair value of identifiable assets, we're having 1000 lakhs. Fair value of identifiable liabilities, we're having 300 lakhs. Fair value of identifiable assets. We have identifiable assets. Their fair value is 1000 lakhs, and they're having identifiable liabilities also. Their fair value is 300 lakhs. Okay. So net identifiable assets we want. So fair value of net identifiable assets, NIFA. Okay, so the fair value of net identifiable assets, which is nothing but identifiable assets minus identifiable liabilities, 700 lakhs. Okay, 700 lakhs. Can I say net assets is 700 lakhs means the value of that business is 700 lakhs? Now, the 700 lakhs worth business, the 700 lakhs net assets means, can we say net worth also the same thing? So 700 lakhs worth business I am purchasing 100% value. So fully I am purchasing by paying 900 lakhs. 700 lakhs worth business I purchased by paying purchase consideration 900 lakhs. I am paying extra amount. No? I am paying extra amount. That extra amount why I am paying means for goodwill. For goodwill. So that means here net identifiable asset is 700 lakhs. Net identifiable asset is 700 lakhs. Purchase consideration is more than the share of net identifiable assets. Okay. Purchase consideration is more than what I am getting. I am getting 700 lakhs worth business, but I am paying 900 lakhs amount. So extra amount how much I am paying, that is resulting for goodwill. That is resulting for goodwill. That extra amount I am paying for goodwill. So we can find a goodwill like that. Okay. Of the same 700 lakhs business, if I paid by the purchase consideration 600 lakhs. 600 lakhs. 700 lakhs worth business I am purchasing, but I am paying how much? It is benefit for me. So it is benefit for me. Yes. That we call it as gain on bargain purchase. Gain on bargain purchase. Generally the same thing will be call it as capital reserve. Okay, in somewhere in accounting standards. So here we are having the aspect called gain on bargain purchase. So I'm bargaining and purchasing the company. I'm purchasing the company for 700 lakhs. I'm bargaining and I'm paying how much? 600. So it is a benefit for me. It is a gain on bargain purchase. 100 lakhs will be the gain on bargain purchase, not capital reserve here. We have to use the word gain on bargain purchase. If consideration is more than the net assets, okay, consideration is more than the net assets, goodwill will come. If consideration is less than the net assets, gain on bargain purchase will come. Ultimately, in the acquisition method, we have to compute either goodwill or gain on bargain purchase. Either goodwill or gain on bargain purchase. So when we will get goodwill, Nana? If purchase consideration is more than net assets. If purchase consideration is more than net assets, which comes under goodwill. If purchase consideration is less than net assets, gain on bargain purchase. So these two things, any one will come. So that we have to find out whether the company having a goodwill or gain on bargain purchase. Okay. It's a compulsorily they will ask you in the multiple choice question. Okay. So you have to identify and you have to find out whether the company is having a goodwill or gain on bargain purchase. If they got the goodwill, this goodwill is arised from business combination. This goodwill is arised from business combination. So generally this goodwill is not self-generated. Okay. So this goodwill is arised from business combination. Okay. So goodwill arising from business combination, how to do accounting, we'll see in the later stages. Now, if you got goodwill means you are showing on the assets. If you got gain on bargain purchase, okay, that will be shown under liabilities, under reserves and surplus. In simple language, if you want to say, under reserves and surplus, gain on bargain purchase also we will show. Capital reserve where you are showing reserves and surplus, same place we will show gain on bargain purchase. So in India's language, we are following division to financial statements. We have a concept called other comprehensive income or other equity. Simply we can say other equity. In the other equity, we will show this gain on bargain purchase. Under other equity, don't confuse, Nana. Other equity means reserves and surplus only. Other equity means reserves and surplus only. The words we have to make differentiate in Ind AS. So in India's balance sheet, if you check, we are having a column called other equity. Other equity means reserves and surplus, all will be there in the other equity only. Equity, other equity. Okay. So equity and other equity. So in the other equity, all the elements of reserves and surplus will come into existence. So in that, we have to show this gain on bargain purchase. In short, we will do accounting, so lot of problems we will do based on this. Okay, so here ultimate concept of acquisition method is in order to find out either goodwill or gain on bargain purchase. So here once again, if A Limited acquired B Limited business, so we have to check B Limited what are the identifiable assets and B Limited what are the identifiable liabilities. B Limited means acquiring company. Identifiable assets of acquiring company, identifiable liabilities of acquiring company. Then we will get the net assets of acquiring company. Which values we have to take? Fair values we have to take. So fair values of net assets of acquiring company, how much? So that net assets, net identifiable assets, fair value is 700 lakhs. Now we know that it is 700 lakhs is a net asset. 700 lakhs worth the business, how much you are paying and purchasing, that is a concept. You are paying purchase consideration 900 lakhs. So then extra amount you are paying for goodwill. Okay. If you pay purchase consideration 600 lakhs, that is benefit for you. That is gain on bargain purchase. Because of this purchase, you got a gain. 700 lakhs worth business I am getting for 600 lakhs only. So 100 lakhs is the gain on bargain purchase. Okay. So this is when we having 100% acquisition. If you are having 100% acquisition, entire 700 lakhs is belongs to you. Entire 700 lakhs worth businesses belongs to you or not? Yes. Okay. In the next case, A Limited purchased business of B Limited. Now 80% only we are acquiring the stakes. So A Limited invested in B Limited for 80% of stakes. In such condition, how do you calculate? The same thing, identifiable assets, fair values, all fair values only we are talking about. Identifiable assets 1000 lakhs. Identifiable liabilities 300 lakhs. Net identifiable assets how much, Nana? 700 lakhs. Assets minus liabilities, net identifiable assets, we got all are fair values. All are fair values. For time being, just think all are fair values. So net identifiable assets 700 lakhs. Now, out of this 700 lakhs, entire 700 lakhs businesses belongs to me. No, I am acquiring only 80% of stakes. Remaining 20%, I am not having any control over that. Up to 80% only I am having the control. For remaining 20%, some other shareholders or outside shareholders will be there. So that we call it as non-controlling interest. I am not having a control over that interest, that 20%. I can say that is non-controlling interest. In such condition, we have to identify what is non-controlling interest. NCI. Okay, it's a very, very important thing. So non-controlling interest. When we are having not fully acquisition or partial acquisition, we can say. So A Limited purchased only 80% of stakes, means remaining 20% is NCI. 20% is non-controlling interest, which is not under the control of A Limited. Okay. If A Limited purchased 60% of stakes, 40% will be the non-controlling interest, which is not under the control of A Limited. In such condition, how can you identify? He is acquiring 80% of stakes. We have to do accounting in the books of A Limited. Yes. So then how to identify? First, we will take 100% fair value of net identifiable assets of B Limited. So what is the 100% value, Nana? 700 lakhs. Listen carefully. Full value we will take. From this, we will deduct non-controlling interest. From this, we have to deduct non-controlling interest. So here, for calculation of non-controlling interest, two methods we have. Okay, two methods we are having for calculating non-controlling interest. Okay, so one proportionate share in the net assets basis, proportionate share in the net assets basis, another one is fair value basis, another one is fair value basis. Okay, both the methods I will show you right now, but in the examination what they're asking, accordingly we have to follow. If they ask PSNA, we have to follow PSNA, proportionate share in the net assets, proportionate share in the net assets. If they ask fair value basis, we have to follow fair value basis. If nothing is given, your wish, maximum preference give to fair value basis. Okay, so proportionate share in the net assets basis means, what is net assets, Nana? 700 lakhs, that is 100% value. Proportionate, how much is there for NCI? 80% acquirer is having, means remaining 20% is NCI. So 700 lakhs into 20%, 140 lakhs. How much balance? 560 lakhs. Can I say this is the share of, this is the share of A Limited? So here balance share of A Limited in the net identifiable assets of B Limited. So we can say, in order to make, no need to write balance, simply share of A Limited, final share, Nana. Share of A Limited in the net identifiable assets of B Limited. Okay, that means out of 700 lakhs, out of 700 lakhs, what is the share of A Limited, Nana? Only 560 lakhs. Only 560 lakhs. Remaining 140 lakhs, it is not in our control. So after deducting that, share of A Limited in the net identifiable assets of B Limited. Can I write like that? Share of A Limited in the net identifiable assets of B Limited. In the net assets of B Limited, how much share belongs to A Limited? Not entire 700 lakhs. Because if you purchase 100%, entire 700 lakhs, your share. Okay, but here we are purchasing only 80%. So 20% we have to remove as non-controlling interest. Only balance 80% is 560. Okay, for 560 lakhs, for 560 lakhs, how much purchase consideration you are paying? So here purchase consideration you are paying for 700 lakhs. 700 lakhs you are paying purchase consideration means, so simply less purchase consideration. How much, Nana? Now purchase consideration is more than the share in net assets. So how much more? Again 700 ochindha. Okay, we can take 800, Nana. You are paying 800. 560 lakhs worth business. 80% value means 560 lakhs worth business. You are paying by 800 lakhs. How much? 240. Extra you are paying means, so you are finding goodwill like this. You're finding goodwill like this. Or 560 lakhs worth business, I am purchasing by paying only 300 lakhs. Then gain on bargain purchase. Gain on bargain purchase. So when we are having 80% or 90%, less than 100% acquisition, anything you made, more than 50%, but less than 100%. So compulsorily you have to find out non-controlling interest. Non-controlling interest you have to find. So three things: non-controlling interest we have to find, goodwill we have to find, or gain on bargain purchase we have to find. I told you here, when it is 100% acquisition, there is no need of calculating non-controlling interest, because non-controlling interest is 0. Okay, when you are having 100% acquisition, there is no other persons to hold the shares. In such condition, entire 100% share belongs to us. There is no question of non-controlling interest. Non-controlling interest, all the stakes belongs to us. When we are having 80% or 60% of stakes when you hold, the remaining percentage will be called it as non-controlling interest, and this non-controlling interest will be calculated under two bases. One is proportionate share in the net assets, what I show you right now. This is proportionate share in the net assets basis. Proportionate share in the net asset basis, we will get NCI. Okay, sir, how can we calculate NCI? How can we calculate NCI in other basis? In other basis, we are having fair value basis also. No, remember this. Goodwill we got, no? 240 lakhs goodwill we got. Okay, so this is under which basis? PSNA basis. If you follow PSNA, that means proportionate share in the net assets basis. When I followed, I got 240 lakhs goodwill. Okay, same question. A Limited, B Limited, 80% acquisition, 800 lakhs consideration, 700 lakhs net assets. That is what the question, no? A Limited acquired 80% of stakes in B Limited by paying how much? 800 lakhs consideration, 700 lakhs is the net assets. 700 lakhs is the net assets. Now we will calculate another basis, fair value basis. How can you calculate under fair value basis? So first 100% net identifiable assets of B Limited. 700 lakhs. 700 lakhs. Less what we have to deduct? Non-controlling interest. Now, proportionate share in the net assets basis means directly 20% I calculate on net assets. 20% directly I calculated on net assets. That we call it as proportionate share in the net assets. 20% share in the net assets. Next one, fair value basis means, see how much consideration they are paying, Nana? 800 consideration they are paying for how much percentage of stakes? 80% of stakes. So here for 800 is for 80% of stakes. For 20% how much? 20% how much? 200 lakhs. That will be the NCI under fair value basis. Under fair value basis, how do you calculate? Means first we will take consideration. How much? Nana, here net assets is not required. Fair value basis when you are calculating, net assets is not required. We will take consideration. 800 lakhs consideration for how much percentage of stakes? For 80% of stakes. Then 20% how much? Okay. So 800 for 80% stakes. For 20% how much? So kindadi by paidi into pakkadi. So here cross multiplication. 800 into 20 by 80. How much? 200 lakhs. Nana, as per proportionate share in the net assets basis, how much NCI we got? As per proportionate share in the net assets basis, how much NCI we got? 140. As per fair value basis, we got 200. Okay. So here, now you calculate the remaining. What is the balance share, Nana, here? 500 belongs to whom? So can I write A Limited share in net identifiable assets of B Limited? For 500 lakhs worth business, how much purchase consideration he is paying? Extra how much he paid? What is the goodwill? Goodwill 300 lakhs. 300. If you follow proportionate share in the net assets basis, if you follow proportionate share in the net assets basis, we got goodwill 240 lakhs. When we follow fair value basis, we got 300 lakhs. So which goodwill is correct goodwill? Fair and then fair value. Huh? So here, both are correct, Nana. So here, when you are following proportionate share in the proportionate share in the net assets, whatever the goodwill we are getting, this goodwill we can call it as partial goodwill. Partial goodwill means this goodwill only belongs to acquirer. This goodwill is only belongs to acquirer. And whatever the goodwill we got in the fair value basis, that goodwill we can call it as full goodwill. Full goodwill means this goodwill acquirer share will be there and acquiree share will be there. So you can calculate in the full goodwill 300. In that acquirer share is how much? 80%. 300 into 80%. Got it? So that we call it as here partial goodwill we will get under PSNA basis and full goodwill we will get under fair value basis. Accordingly to the question, NCI under fair value basis or NCI under proportionate share in the net assets basis, they will ask you. Now we will do lot of problems relating to that. Don't worry. So you can understand one by one. Okay. So here generally we have to check. We are finding the goodwill or gain on bargain purchase. If consideration is more than net assets, we are having a goodwill. If consideration is less than the net assets, we are having gain on bargain purchase. Okay. If any acquisition is less than 100%, okay. So in such condition, NCI we have to calculate. So non-controlling interest. Non-controlling interest we are calculating under two bases. One is proportionate share in the net assets basis. That means net assets how much? In that proportionate share. So net assets is how much, Nana? 700 lakhs. And that proportionate share means 20% belongs to NCI. So out of 700 lakhs, 20%, 140 lakhs belongs to non-controlling interest. We will remove that. Then we will get the balance. The entire share is belongs to acquirer company or A limited company. In such condition, we are comparing with that balance amount with the purchase consideration what A limited is paying. For 560 lakhs, they are paying 800 lakhs. So for 240 lakhs extra, they are paying for goodwill. That is acquirer share. Okay. When we are going for fair value basis, NCI calculation under fair value basis, don't go with the net assets. So check the consideration, how much we are having. Consideration, how much we are paying. 800 lakhs we are paying for 80% stakes. 800 lakhs you are paying for 80% stakes, then 20% how much? That is the fair value basis. So then 20% we got 200 lakhs. So then we got 500 lakhs is the share of A limited. And for 500 lakhs, how much he is paying? 800 he is paying. So extra 300 is the goodwill. In this goodwill, both goodwills are included. The goodwill of acquirer share, the goodwill of acquiree share. Okay, in 300 lakhs, 80% is nothing but 240 lakhs only. That means when you are preparing goodwill under proportionate share in the net assets basis of NCI, we will get partial goodwill. When you apply fair value basis for NCI, we will get full goodwill. Okay, so that is the only difference. Got the point? Okay, so I will give you the notes before that. So just to understand what is goodwill, what is gain on bargain purchase, have a clarity, Nana. If purchase consideration is more than net assets or share of acquirer, simply we can say acquirer share in the net assets. If purchase consideration is more than acquirer share in the net assets, that we can call it as goodwill. If purchase consideration is less than the acquirer share in the net assets, we can say that is gain on bargain purchase. Gain on bargain purchase. Now you open your material. Textbook content we can see. Nana, how to find the goodwill and gain on bargain, but with the format, I will give you the data. Don't worry for that. So why I am discussing that element means you should know what is goodwill, what is gain on bargain purchase. Then you can understand some theory over here. Okay. Open your material, accounting for business combination and restructuring. So once check theory of business combination. So objective, Nana. Ind AS 103 deals with business combination. So what is the objective of business combination? So the objective of this standard to improve the relevance, reliability and comparability of information that reporting entity provides in the financial statement about the business combination and its effects. So when we are making any business combination, acquisitions, absorptions, mergers, so how to do accounting, this standard will specify. To accomplish that, Ind AS establishes the principles and requirements for how the acquirer recognizes and measures in its financial statements the identifiable assets acquired, the liabilities assumed. So identifiable assets and identifiable liabilities, how we have to recognize in his books of accounts. Who is he, Nana? Acquirer. So acquirer, how to record identifiable assets and identifiable liabilities by the acquirer in his financial statements. So here we are getting, and any non-controlling interest in the acquiree. So what is non-controlling interest? That non-controlling interest, the acquirer does not have control over that. So that belongs to outsiders or other shareholders. Clear? So these two accounting we are doing, how to do accounting for NCI and how to do accounting for identifiable assets and identifiable liabilities. Next one, recognizes and measures goodwill acquired in the business combination or gain from a bargain purchase from the business combination. If you get goodwill, how to do accounting for that, and if you get gain on bargain purchase, how to do accounting for that. Okay, the two elements. First, they will recognize how to recognize identifiable assets and identifiable liabilities of acquiree company in the books of acquirer. Acquiree company assets and liabilities, how to recognized in the acquirer books of accounts, and how to recognize and measure. So these standards will deal. At the same time, if any non-controlling interest is there, how to do accounting for non-controlling interest also, Ind AS 103 will deals with it. At the same time, if any goodwill is arising out of this business combination, any goodwill or gain on bargain purchases arising out of this business combination, how to do, how to measure and recognition also, this standard will specify. And it determines the information to be disclosed to the users of financial statement to evaluate the nature and financial effects of business combination. Ultimately, in the financial statements, when we are disclosing all the elements of business combination, it is enables the users who are checking your financial statement, what are the effects are happening in the business combination in the entity, so they can understand it better. It applies to Ind AS applies to a transaction or other event that meets the definition of business combination. What's the definition of business combination? Any entity acquires the control over the business of another entity. So this standard will apply in such circumstances. And it does not applies to, this is important. So which we can say that scope exclusions. Ind AS 103 does not apply to the accounting for the formation of joint arrangements in the financial statements or joint arrangements itself. For any joint arrangements or joint operations are there, Ind AS 103 will not apply. Which standard will apply? Ind AS 111 will apply. Okay. Next one, the acquisition of asset or group of assets that does not constitute business. So there is no business. If there is no business, this standard will not apply. The acquiring company is not having any business. So if they are not having any business, if you acquire such company, Ind AS 103 will not apply. This is only the business combination. If the business is there, then only this standard will apply. And accounting for combination of entities or businesses under common control. So generally Ind AS 103 business combination under common control, they will not deal in the standards, but we are having Nana in Ind AS 103 we have a carve-in, as I told you, that appendix C of Ind AS 103 business combination, we are having an accounting for common control. Acquisition method will not apply, but pooling of interest method will apply. Okay, so that we will discuss when it comes under business under common control. Common control is nothing but before business combination and after business combination, same shareholders will be the owners of that company. Okay, that we call it as common control. In that common control, sale of divisions will come. Sale of divisions will come. Spin off elements, whatever the thing we can say. If a company having two divisions, one division is selling, and one division is selling to some other company. In simple example, I can say, so for in short, to understand about business combination under common control, I'm having two businesses. My company is AB Limited. I have business A and business B. Business A is successful. Business B, I'm getting some losses. So what I will do, I will sell this business. I will sell this business for lower cost or whatever it might be. And this business I sold to Z Limited. This business I sold to Z Limited. Now Z Limited have to pay purchase consideration, Nana. So generally Z Limited have to pay purchase consideration to AB Limited. AB Limited. If they are paying purchase consideration to AB Limited in the form of equity shares, now Z Limited also same equity shareholders are there. AB Limited equity shareholders will become the Z Limited equity shareholders, but entire purchase consideration they are paying through equity shares. Have you got my point? Entire here AB Limited we are having AB Limited having equity shares, Nana. Equity shareholders, simply we can say equity shareholders we are having. Listen, it's an interesting concept. Business combination under common control, we have a separate element. Second model is that only that we are going to discuss that. AB Limited we're having. AB Limited having two businesses, a business A and business B. Business A is successful, business B is failure. Business A we will sell. Which one? Business B we are selling. That we can call it as sale of division. Sale of division or split off. I am splitting the business. Okay. So one division I am selling to Z Limited. Okay. In place of purchase consideration, Z Limited issued equity shares. Entire purchase consideration, they are issuing equity shares. Now I am saying that who are the equity shareholders of AB Limited are the same shareholders are there in Z Limited. Because you are giving what? Equity shares only. So equity shareholders of AB Limited, and after this combination also, they are the equity shareholders of new company Z Limited. So then we can see it is under the control of equity shareholders, Nana. That we call it as common control. Common control. Okay. So this demerged entity and whatever the thing. So demerger, we can say it is also called as demerger. So that we will discuss in the second element of business combination. Present it is not required. Here what is required to understand about the elements. So relating to business combination under common control. So generally Ind AS 103 will apply in different scenario. In appendix C, as I told you, acquisition method we are not applying. For that, a special method we are having, that is pooling of interest method. Only in business combination under common control. Next one. The requirements of this standard does not apply to the acquisition by the investment entity as defined as 110 consolidated financial statement. Now, in consolidated financial statement, Ind AS 110, there is a definition of investment entity. Investment entity, investment in the subsidiary. See, if I am acquiring 80% of stakes, I am getting a control. If my company is investment company, everywhere I am putting investments. In such condition, here what is the business model for investment company? Making investment. If investment raises, immediately they will sell and they will gain the profit. Okay. So major thing is that is not contractual cash flow. They are not investing for dividends. They are not investing for dividends. They are investing for, if they get more price, they will sell in the market. Okay. In such condition, their motive is not to control the business, only just for investment to gain profits. Okay. So investment entity means some X Limited is an investment entity. The major motto of this X Limited, they are making investments in all the companies. Okay. Sometimes in the A Limited, when they make investment, it crosses more than 50% of stakes. As I told you, more than 50% of stakes when you hold, you will get a control. But here A Limited, here X Limited is an investment entity, as I told you. X Limited intention is that not to control A Limited, just for investing in A Limited. When they get more profit, that means when the price of that particular A Limited shares increases, immediately they will sell. So that is a major concept of investment entity. Investment entity is nothing but they are investing for gaining the profits. They are not investing for controlling the enterprise. If control is not there, this business combination will not apply. Ind AS 103 will not apply for investment entities whose major intention is not to control the business. Their major intention is to gaining the profits by selling the investments, buying and selling the investments. So that is about the investment entities. Such investment entities, when they invested in any companies, sometimes it will crosses more than 50% also, but still they will not get any control. They are not attaining any control. They will not control the business. So instead of that, what they will do, when the price raises, immediately they will sell and they will gain the profits. Okay. Such investment entities are investing in the subsidiaries. We can say more than 50% means subsidiaries only. In such case, Ind AS 103 will not apply. So see here, the requirements of this standard do not apply to the acquisition by the investment entity as defined as per Ind AS 110. What is the investment entity? Definition clearly given. Ind AS 110 means next topic, as I told you. So there we will discuss about the definition of investment entity. So of investment in subsidiary that required to be measured fair value through profit or loss. So that will be required to, they are not maintaining, they are not recognizing in the balance sheet. Instead of that, they are recognizing in the fair value through profit or loss. They're getting either profit or loss. Accordingly, they will recognized in the profit and loss account. Sir, what is fair value through profit and loss means? Ind AS 109, we will get a clear elements relating to that. Financial instruments. Okay, we're having 3 reclassification of investments. When you are making any investment, it will comes under Ind AS 109 financial instruments. So, first of all, when you are classifying the investments, we can classify based on their contractual cash flows. One investment I make only for dividend. One investment I can make to gain profits if the price is increases. Sometimes I will make an investment. Generally, my intention is to getting the dividend only. But my another intention also there. If I gain the profit, I can, if I raise the share, I can sell that investments. If two intentions are there, intention of the parties. Based on that, we will classify the financial instrument. Financial instrument means, as I told you, it is an investments. See. One second. No. Actually, clear knowledge we will get Ind AS 109 when we are discussing about that. See, in the balance sheet, I'm having investments. Asset side, I'm having investments. Can I say investment in equity shares of some other limited? Okay, some other company. We can say A Limited. Investment in the debentures of B Limited. These all are investments, Nana. These all are investments for my company. Why I invested in the equity shares? Two intentions I can have. One intention is that I can receive the dividend. Every year I will receive the dividend for dividend purpose. That means it is a contractual cash flow purpose. Contractual cash flow purpose. I am investing in the equity shares of another company. And another intention is that I am investing in the equity shares. In the future date, A Limited share is increased means immediately I will sell. I will get a profit. For 10 rupees, I purchased an equity share. Okay, so after 2 months, it increased to 20 rupees. Immediately, I can sell and I can gain the profit. My intention is to sell the share in the future for gaining the profit. Two intentions. And some intention will be there. Initially, I intended for holding only. Initially, I intended for holding for dividend only. But some point of time, I came to know that I want to sell. I want to sell that when I get a better amount of share. We can say that when I have an increasing amount of share, I can get a profit. So based on that intention, we are classifying the financial instruments under 3 stages. So generally, amortization method we will follow here. Amortization cost method we will follow, and fair value through profit and loss, and fair value through OCI, other comprehensive income. So these reclassification we will made when we are applying Ind AS 109. Sir, for which one we have to follow amortization cost, for which one we have to follow P&L account, and for which one we have to follow OCI, we will discuss in 109. Okay. So here why we discussing all these things means, see here they have given that the entity obtains a control, sorry. So here, investments in the subsidiary is that required to be measured fair value through profit and loss. Through profit and loss is one of the method of holding the investment based on the purpose. Okay. So investment, why you hold? Investment in the subsidiary. Subsidiary means automatically you came to know that more than 50% of stakes we are having. Then only it is my subsidiary. But investment entity intention is that not to hold it for dividend or not to attain a control. But their intention is that in future, if the price of that subsidiary increases, immediately they will sell. Okay. So that's why Ind AS 103 will not apply for such investment entities that require to be measured through profit and loss. This point you can understand in 109 only, Nana. Okay. Here it is not required. Again, I will tell you. So when we are discussing about 109, we will come back and we will see this point. Okay. So now, that much depth is not required. Generally, it is not applied for joint arrangements. It does not apply which do not constitute any business. If any business is not there, business combination will not apply. Business ఉంది కదమ్మా. So business లేకపోతే business combination లేదు. So next Nana. So under common control entities, business combination of entities under common control, 103 will not apply. But appendix recently added that. So we are having a carve-in method. Ind AS 103 we are applying in different method, not acquisition method, but pooling of interest method. and it is not applicable for acquisition by the investment entity as definition which is given under Ind AS 110 consolidated financial statements. Okay, so up to here. In the next session we will see accounting for business combination. Already we have done all the steps, the same things again we're going to discuss: identification of acquirer, acquisition date and all.